Good morning, everyone. My name's Lucas Postlethwaite. I'm the marketing manager here at AuctionsPlus. Welcome to another edition of AuctionsPlus Presents. And this morning, it's what's the best use of your available feed this summer? So we've got an action-packed agenda for you this morning. We've got two lovely representatives from the MLA. I've got Penny Graham and Stuart Bull. We've also got Phil Graham from Graham Advisory. And to finish up, we've got Hilary Beech from Holmes, Sackett, which is now Aggregate Consulting, as I understand. And so just to recap on what this one's about. So we're aiming to explore the upcoming summer and autumn period, considering the season, considering available feed, market dynamics, with the broad aim of helping producers make more informed management marketing choices, leading into a bumper season with markets vastly different from this time last year and from other times that this sort of thing has occurred. So hopefully you'll gain some new insights for this summer season. So I now hand it over to Penny Graham and to Stuart Bull from the MLA. Thanks for being with us, guys.
Okay. Good morning, everyone. So I'm Penny Graham and I'm a market information analyst here at MLA. This morning, I'll just quickly run us through the latest sheep projections, which we released at the end of September, and then hand over to Stu, who'll run through the cattle projections. So the three key takeaways from the sheep projections that we identified as being key themes are annual lamb slaughter to be revised lower, which is now estimated to hit 20.3 million head in 2020. The short-term economic impacts and reduced food service activity, which could hinder lamb and mutton exports, and recovering global demand and improved restocker competition, which will lend support to the flock rebuild. In preparing these projections, there was the assumption of average to above average seasonal conditions forecast for the remainder of 2020 throughout Australia's eastern sheep producing regions, while the outlook for WA forecast average to slightly below average conditions. At the time of publication, so about a month ago, the latest BOM outlook forecast well above average rainfall for eastern and central states through to the end of the year, which has largely remained current. With the national flock in contraction for the past 3 years, the impacts of improved seasonal conditions and higher productivity have seen producer intentions shift to focus on a flock rebuild. In contrast to the elevated slaughter in recent years, in 2020, processors have faced robust competition from restockers for a diminished supply pool. Interstate transfers from WA to the eastern states have held up throughout 2020 as producer intentions to rebuild in New South Wales and Victoria remain resolved. The national sheep flock at June 2020 was estimated at 63.8 million head, which was a decline of 3% year on year and the lowest level recorded in over a century. Following the aforementioned improved conditions, as well as reports of increased lamb survival and marking rates through winter, the national sheep flock has been projected to increase 3.9% to 66.6 million head in 2021, with the peak of the rebuild occurring in 2022. Looking to national lamb slaughter, with the assumption of favourable conditions for the remainder of 2020, there's the expectation that producers will retain larger numbers of ewe lambs from the spring crop to rebuild breeding stock. This will see fewer lambs enter the market for the rest of 2020 than seen in previous years. When combined with processor shutdowns and reduced processing capacity in recent months as part of COVID-19 restrictions in Victoria, the throughput of lambs entering southern markets could be significantly impacted. Therefore, despite an increase in the number of lambs on the ground, national lamb slaughter for 2020 has been revised slightly lower to 20.3 million head in 2020, a decline of 6% year on year. The NLRS Eastern States Weekly Slaughter report has seen lamb slaughter tracking on average 8% below year-ago levels throughout the year, supporting the projected 6% decline. Looking at national sheep slaughter, it has been sitting well below year-ago levels throughout 2020, following 2 years of high breeding stock turnoff. The aforementioned conditions will see increased retention of productive breeding ewes as producers look to rebuild flocks, with national sheep slaughter forecast to decline 33% on 2019 levels to 6.3 million head. NLRS Eastern States sheep slaughter has averaged 36% below year-ago levels for 2020 to date, again supporting the projected 33% decline in sheep slaughter this year. National lamb carcass weights have also been revised slightly higher for 2020, up 3% on 2019 levels to average 24 kilos a head in 2020. Greater feed availability across many key sheep producing regions has created increased opportunity to feed to heavier weights. Lamb carcass weights are expected to remain close to the current projected levels for the remainder of the projections period, out to 2023. Sheep carcass weights are also expected to rally in 2020, revised higher to 24.9 kilos a head, which is also an increase of 3% on year ago levels. In recent years, carcass weights have been buoyed by elevated numbers of supplementary fed stock, while improved feed availability is expected to bolster carcass weights to the end of 2020. The projected increase in carcass weights this year is not enough to offset the decline in slaughter, with lamb and mutton production both forecast to reach the lowest levels since 2014 and 2012 respectively. Lamb production is expected to ease 3% to 487,000 tonnes carcass weight, while mutton production is projected to contract 31% to 157,000 tonnes carcass weight, in line with reduced slaughter levels. The Australian export industry continues to face a multitude of headwinds, including declining domestic supply, wavering international demand, fluctuating currency rates, and recessions across a number of key market destinations. Global market conditions remain unpredictable, particularly due to the impact of COVID-19 and its influence on food service industries around the world. These dining outlets are usually a key channel for Australian sheep meat due to Australia's status as the leading supplier of high quality lamb into global markets. For high-end food service outlets, a full-scale return to pre-COVID-19 demand is unlikely in the short term. However, promising signs have recently appeared across a select few markets. Tightening domestic supplies have also been a major limiting factor for sheep meat exports this year. Lamb exports for the year to August were down 9% on 2019 levels, while exports of mutton were back 21% on 2019. Approximately 60% of exported Australian lamb is channeled straight into the food service industry, and given the impact of COVID-19 on dining out, this has had a big influence on international demand. The flow of Australian sheep meat exports through to the remainder of the year is expected to continue to fluctuate as markets move through different stages of their COVID-19 recoveries. Export forecasts for the year have been revised lower due to the softening global economy, COVID-19 impacts on global demand, and reduced supply on the back of positive rainfall outlook. Lamb exports in 2020 are forecast to reach 269,000 tonnes shipped weight, a 5% decline on 2019 levels, while mutton exports are forecast to ease 32% to 126,000 tonnes. The US has been a key market for Australian sheep meat this year, accounting for 21% of total exports through 2020, up from the 5-year average of 17%. However, due to the premium placement of lamb through food service channels, COVID-19 will continue to have an impact on import demand, with prices for food service items such as racks well below year-ago levels, while prices for retail cuts of lamb are holding up quite well. With the Northern Hemisphere winter looming, there is further uncertainty into how food service demand will cope as patrons look to dine indoors. Lamb exports to China have performed well through 2020, back just 1% for the year to July, sitting ahead of the US and the Middle East as the top destination for Australian lamb. China has made some positive steps towards a COVID-19 recovery, with domestic travel having been available for a few months, allowing businesses to regain some much needed momentum as residents shift back towards typical consumption patterns. Sheep and lamb prices have declined considerably since June because of processor disruptions in Victoria and reduced food service demand, despite a reduction in lamb turnoff and a COVID-19 related growth in retail demand. Producer intentions to rebuild flock numbers have seen demand for restocker lambs overtake finished lambs for much of 2020. The recent downturn in prices across all lamb categories can be attributed to the increased throughput of lambs in sale yards, particularly in New South Wales and Victoria. Last week, the National Restocker Lamb Indicator averaged 8.43 cents a kilo, which was a 92-cent premium to the national trade lambs, which were reported at 7.51 cents. While restockers traded at a 104-cent premium to heavy lambs, which averaged 739 cents a kilo carcass weight. Mutton prices have held up well relative to lamb this year due to a significant decline in supply as producers withhold ewes to rebuild flocks. A strengthening Australian dollar and subdued demand in key export markets have contributed to mutton prices declining from June to September. Despite this, the national mutton indicator has gained momentum and last week was reported at 5.99 cents a kilo, 42 cents higher than year-ago levels. For the remainder of the year, lamb and mutton prices are unlikely to report significant increases, as subdued processor competition and decreased global food service demand add further downward pressure on the market. However, moving into next year, an anticipated recovery in overseas demand, robust domestic restocker buying, and limited supply availability should lend support to prices. I'll now pass over to Stu, who'll give an update on the cattle projections.
Thanks, Pen. So guys, thanks for having us. We're gonna, the projections are actually getting released tomorrow. So we're gonna provide you with a quick snapshot of what to expect to get a bit of an inside view before they're released. There's a lot of kind of similarities between sheep and cattle, obviously with the season and the state of the current domestic market. But of course there are some differences as well. The key themes that will be discussed and that will go out into the projections released tomorrow is that the adult cattle slaughter forecast 7 million head for 2020. So again, that's coming for the end of this year. So that's about 2 to 3 more months that we're expected to hit 7 mil. Recovering global food service demand and retention of breeding stock will support herd rebuild. And the African swine fever remains a critical influence on the global protein trade in 2020. So these themes, I guess the foundation of what to expect. A quick one with obviously seasonal conditions. We've seen pretty good rainfall in key southern states, so Victoria and New South Wales, whereas Queensland haven't seen that as much leading into September. And WA has been very dry as well. For the next few months, we're expecting the La Nina to emerge. So that's above median rainfall, pretty much for all of the eastern states and a lot of the top end as well. With WA not expected to see as much rainfall as the eastern states. And we've already seen Queensland get some rainfall as well. So we're expecting that to continue, which will have a significant impact, we think, on where the domestic market lies for the remainder of the year. Looking at the herd, so as you can see in the yellow there, that's where we're heading. There's a significant decline from 2019. So we're kind of due to the drought. We've seen a high turnoff of cattle, of both breeding stock and males, as just the conditions were so poor. So hence we've seen such a large decline in the herd, with the expectation that the herd will consistently rise over the next few years. And we're looking at hitting 25.1 million head by the end of the financial year, so at the end of June 2021. And then again, we're well below the average of 28 million head. So yeah, we've still got a bit of work to do. All right, looking at slaughter now. So as you can see, we've seen a decline in slaughter this year, which was expected. This is captured by our data, not the ABS. So yeah, we've seen an uptick in the last couple of weeks, but the general trend is going down, well below year ago levels and the 5-year average. And we expect that to continue to decline for the remainder of the year. Slaughter is usually pretty tight throughout winter and spring due to calving time and just due to the lack of cattle and how low the supply is currently. So when we look at the female slaughter as a percentage, or I guess as a portion of the overall amount of cattle being killed, so we don't have the most recent ABS data. So this is based in June, but essentially the premise of the previous projections is that we expected the female kill to be coming lower, which we weren't seeing. So we've had to kind of revise that slightly, not for this round, but for the previous round. And I think we're around 55% for females in proportion of the overall slaughter. which is quite high. We expect that 47% is usually the target where we consider the herd to be in full rebuild. But in saying that, again, this is back in June, so time has passed since then. And from our data, we've seen that the proportion of females killed compared to male is increasing. So we're seeing more and more females. We're seeing more females being retained and less going to slaughter in comparison to male and the overall total. So looking at some of the indicators that I'm sure most of you would be aware of, the EYCI is, I guess, the main one that we use to look at store cattle, so young cattle. The EYCI's kind of gone through the charts this year. As of Thursday, we reached an all-time high of 801. And as you can see, it's well above previous years. So again, the key drivers of that is the demand for young cattle in the search to rebuild herds and to breed as well. So we're seeing higher numbers of stock retention, and hence we've seen such a lack of supply mixed with a high demand has led to the record prices that we've seen since the start of the year. And a lot of that aligns with rainfall as well. And here's a comparison against the heavy steer. So this gives us a good look at what store cattle are doing in comparison to heavy cattle. So we can see, obviously, the EYCI has continued to rise throughout the year, showing the strength of the domestic market. And the heavy steer market, we saw that big lull at the during 2020 was COVID. So while we did see a drop for most cattle categories, obviously that was kind of expected, and we saw that with lamb and mutton as well. We have seen the EYCI prevail on the back of rainfall. So again, store cattle being bought on the back of rainfall during that kind of peak COVID period. However, we saw the heavy steer, which a lot of that gets processed, so it's sent for export, for consumption. And with the decline of food service and retail overseas, we saw those key categories take a hit. And now looking at a range of indicators now, just to kind of highlight the differences between each. So as I alluded to before, the trade steer, which is a lot of that meat that's processed from a trade steer is destined for retail. And we know during COVID, the domestic retail space was very hot due to all the panic buying and people stocking up during those times. So that kept the trade steer afloat. And then, as I was alluding to before, the heavy steer and the medium cow took the largest hit. So you can see a big lull there during March in 2020, the red and the green one. The red and the green and the grey. The red is the 100-day grain-fed steers. That's looking at the grain-fed price, which aligned with the heavy steer and the medium cow price. And again, a lot of that is manufacturing beef. So it's getting sent to food service, to retail chains over in the States, for hamburgers and such. And the majority of beef that we produce, again, goes through that sector. So they took the largest hit. So I think it's just important to realize that, while young cattle and the Eastern young cattle is going gangbusters, during that time, the majority of categories did suffer, and hence we saw that decline. But since then, we have seen, due to the emergence of food service and key markets starting to ramp up production, we have seen those indicators come back closer to the Eastern young cattle indicator. For cattle on feed, so last year we had record levels of cattle on feed at 1.24 million head. Again, that was on the back of a severe drought, so a lot of producers weren't holding on to stock. So hence feeders were grabbing those, and we're paying the premium for young cattle, and we're bulking them up to be sent overseas and consumed domestically. Since then, due to the change of conditions, we've seen a decline in the amount of cattle on feed. Again, very difficult to acquire sufficient numbers of cattle presently, and that's due to the low supply and the increased competition between restockers, feeders, and processors. So it's still well below year ago levels. And yeah, I guess we've seen lower utilisation rates at feedlots, and that has been a key reason as to why we're seeing prices be as high as they have ever been. Again, low supply and high demand. Now, looking at the international scene, so this is volume of products sent overseas. As you can see, 2020, we are below on all categories. But I would say that's still not a bad outcome considering what the global market has seen during COVID and the fallout of that. So we are still tracking below, but we are getting increasingly more exports overseas due to the opening up of food service over there, and the COVID pandemic is starting to ease. So it's interesting when we look at volume, how it's come down, but then if we look at value, so the value of exports to key markets, we're actually up in the US and pretty well in line with Japan and very close with China, with Asia really ramping up. So this can be explained by a few different factors. Again, value is in dollars terms. So essentially the high prices that we have in Australia are out of sync with the rest of the world, which I'll show you in a sec. Hence, we have seen the value in proportion to volume rise, and we're up for all those key markets, or for most of them. But yeah, we've seen recently Japan has been very strong, as of the US. Again, China is probably the major player, and we've seen Brazil really increase their ties with China, and due to their lower market rates, they seem to be in the hot seat at the moment in terms of the amount of exports going out, due to their prices being better, along with the exchange rate as well has been rising over the past few months as well here, so which also makes us less competitive. But despite this, we're seeing great value through what we are exporting, and the volumes are also ticking up as well. Again, here's China, as I was alluding to before. You can see Brazil has taken off, as of Argentina and Australia as well. We're doing better than last year, which I didn't expect that personally, but it's really good to see. And as I was alluding to before, global cattle prices, so Australia there, we're in the yellow, we're miles above everyone else, and that's due to, again, that restocker sentiment. So people very hungry to restock and to buy cattle, which has pushed up prices all through the supply chain, therefore making global cattle prices higher than the rest. Again, we're in kind of a unique circumstance on the back of extreme drought, probably the worst, or it gets close to the worst we've had in history. And then the sudden change in season has really shifted that scene. So that's why we're seeing global cattle prices way above the rest of the world, which again has its limitations as it makes us less competitive. But again, we expect that on the back of what we've seen so far and supply continuing to dwindle, prices will remain up for the foreseeable future. And again, we'll kind of have to see how things play out within the global scene as the COVID pandemic continues to roll on. But generally, we're quite optimistic around where Australia are going. And yeah, so thank you. Feel free to have a look at the projections going out tomorrow, and that'll have everything in detail. But yeah, thank you.
Awesome. Penny and Stu, thank you so much for that. So ladies and gents, for our next segment, we've got Phil Graham of Graham Advisory. So Phil had 10 years in private ag companies before working for the New South Wales DPI from 88 through to 2017. His last position for 10 years was Technical Specialist of Livestock Systems, covering both sheep and cattle with statewide responsibilities. His area of expertise is understanding livestock production systems and working out the changes that will improve profits without increasing risk. These factors will change as you move around the state and enterprises, of course. Phil's worked with various producer groups, funding bodies, the LLS, universities and private companies to determine the key drivers in different production systems around the state. This also includes issues facing mixed farming systems. Phil was involved in the development and delivery of ProGraze Plus, Stock Plan, and 5 easy steps. So today his key messages will be a big spring dose, not equal big profit in livestock industries. The actions you need to take to turn the feed into dollars, and that'll be the focus of the talk. So Phil, take it away and welcome.
Thank you very much for that, and thanks for AuctionsPlus for organising this. Good morning, ladies and gentlemen. We're getting used to doing things like this. One of the downsides for me is I don't know who's out there and I don't know where you are. So I'm sort of pull this talk together on the basis that I'm talking to people who are predominantly through southern New South Wales and into Victoria. And I don't know what it's like at your place at present, but it's pouring rain and it must be about 5 degrees in Yass. So I'm sitting here on the cold side. Let's get into it. What's this season give to us? There's certainly opportunities and there's also threats. And so the talk today, I want to go on both sides of the equation. The opportunities, we have feed, there is the ability to do short-term trading, and I'll come into that later on. You've heard the latest market conditions. I'll leave you to analyse the pros and cons of what the market is presenting to you at present. The other thing I'm most likely at the start going to spend a bit of time on, there are threats, and this comes from my experience over the years, in that after previous big years, we've seen large weight losses in breeding animals, principally sheep, but it does also happen in cattle, especially in late summer and autumn, which ends up having a big impact on reproductive performance for 2021. And that there flows through to the bottom line. Now, it's certainly this risk is greater in sheep, and we'll go into that in a bit more detail. And the bottom one, it's certainly been my experience. Don't assume that big springs automatically means you get an increased profit. That is certainly not the case. If you want to take this grass and turn it into dollars, you need to take specific actions to occur. It does not occur naturally. I suppose just to put in context what this year's been like. So these are pasture growth rates that I've measured off a site I've run since the early 1990s. So we're on the western edge of the southern tablelands. If we travel 5 kilometres west of this place, you're on the southwest slopes. So there's some pasture growth rates, and these are growth rates I've measured under grazing. So they're not growth rates from cages, which give you a slightly inflated figure. And all the little crosses are the various growth rates from the year 2005 through to this current year. And those crosses, which have been very elegantly circled, are in fact represent the growth rates I've measured in 2020. So if we start at April, we're seeing that 2020 is the highest growth rate I've measured over that time period. We go to May, it isn't the highest, but it's certainly up there. June was a bit of an average. It sat in the middle, but still pretty good for June. And then the standout of the year to some degree was July. That July figure's virtually double the average for July. Now, from my experience, if you measure something that's double a long-term average, my first reaction is you've made a mistake. So that paddock got in fact measured twice, and I did the calculations 3 times, because in the back of my mind it just said these sort of things don't occur, but it did. And really that what I measured at this site was well and truly reflected in what other producers around large areas of New South Wales were telling me. And for us here on the Southern Tablelands, August, I suppose I'd regard as the only time we really had winter. We had 3 fairly solid winter weeks there. But even in those conditions, the growth rate was just at the top. And then we look at September, and again, it's just jumped out of the box compared to what else I've measured over that period of time. It is very unusual to get a season where you get that many months that are above average. We'll often get years where we might have that might do it for 2 or 3 months. But here it's been consistent over quite a few, and I've got no hesitation in saying that when I go and measure October's data at the end of the month, I think again it's going to be sitting in the upper echelons. The other thing that's been a feature of this year is the incredible clover growth and percentage, and I suppose that was really driven by the good moistures early on, and June just put the cream on the cake. I have never seen a clover year like this before in my 40 years. So that's just setting the picture of what we've got. And I think except for the South Coast and the Monero and the Gippsland, vast areas of the South and in Victoria have experienced similar things. And while the data here is pasture growth, for those in the mixed farming zone, you've seen exactly the same sort of responses in the grazing crops, which people have had a lot of trouble keeping under control this year. These growth rates have tended to push the season ahead. So a lot of producers are saying to me, they're sort of saying that the season's 3 to 4 weeks ahead of where they'd expect. And if I look at herbage mass data that I've collected over the years, that's sort of backing it up. So here we are in late October, but to a large degree, you're most likely a month ahead of herbage mass of what you'd normally expect. So that's what the season has given us. I just want to show 2 sites now, and you'll notice that this is the one for Victoria. And the reason I'm just putting these 2 up is that these are something that could be of value to you in the future. We are seeing these things more and more. Both the sites I'm going to show have just appeared on the web in 2020, and both are in an expansion phase. This is the one for Victoria, and all those dots you can see where they've got soil moisture probes under pasture. They also have crop probes on this side as well. I haven't shown those. So you can click on each of those and get a visual graph of what's happening to soil moisture and some comments about pasture growth. So that's the Victorian one. It came on the web this year, and I know they'll continue to expand that. The other one, which I suppose I'm more familiar with because I've been involved with, this is one which at present is covering the southeast region of New South Wales, so from the Southern Highlands down to the Victorian border. It's been pulled together by Southeast Local Land Services, Monero Farming Systems, Tableland Farming Systems, and Bukamag Bureau, with very kind support from the federal government. So what you can see is just sort of the front screen. On the top left, you've got data about what's happening with soil moisture at the various depths that the sensors on the probes sit at, and this is data which I downloaded. It's up to date. It was as of Sunday. And what those percentage figures are telling you is what of the available moisture that band can hold, how much of potential have we got? So if you look at that site, which at present I've just flicked up, which is at Bookham, that soil is at, virtually near 100%. If I picked up tomorrow's reading, at those 4 levels are most likely going to be at 100%. And then over the right-hand side, you've got a bit of a look at pasture, which I'll just flick to in we'll put another one. So again, this is for the Bookham side. If we go into a bit more detail, what you can see is the soil moisture, and the bottom graph is for last year. So from the 1st of November 18 through, and then we go from the 1st of November 19 up to the current. So it gives you a visual picture of how soil moisture has varied during the year, and we can see the contrasting situation we're in now when we've nearly got a full profile of moisture for plant growth compared to where we were sitting at this time last year. Producers find this very useful, and I know a number of producers will use this during the year if they're thinking about making trading decisions. They're getting this view of what is the underlying moisture, because that's the water in the bucket which is going to drive growth. Is it low and therefore I'm under great risk, or have I got a lot of sort of reserves sitting there? And at this site, a full bucket gives you about 6 weeks of full pasture, full spring growth. So where we're sitting at present, we're still going to have green in this system, even if we had no more rain through to the end of December. It was a bit quick. The other thing it throws up is this one's about herbage mass, green herbage mass, and the likely risk. So you've got 3 colours in the background, and that's historical. This is giving us an idea of where we might expect pasture for this time period to have sat over time. So that's the 10 percentile line. So there's 30 years of data in there. So there's 3 years that it sits in this band. That little band there is the boundary between the 10 and 25. That's the 25% percentile. The top of that, the changing colours there is the 50-50 mark, and that sits at the 90%. So historically, that's where green feed might have sat. The black is what we call the tracking line, is telling us how things are tracking this year. And the other 3 coloured lines are projections, and this work is done at the start of every month. So that's why so at the start of October, this work, the data all sits on a computer of Cyros down in Hobart, and they do the work, and we get this projection. And what this projection is, given the soil moisture and pasture and animals that were on this site at the 1st of October, and it uses the last 30 years weather, it generates potential where we potentially might be. So if we're at that point and the season went against us, so it's the 10 percentile outcome, that's the projected path of where the green feed would be. That's the medium path. That's the 90%. So at this particular site, we can see that the tracking line is moving along the 50%. You can vary that. So it's giving you some idea of what is the risk. And I'm going to show another site, but just to look at how, to some degree, how the 3 coloured lines here, the red, the yellow and the blue, pretty well move in unison for about a month before they start splitting apart. And that's principally driven by there's good moisture in the soil, so the site isn't as sensitive to rainfall. If I go to the next site, and I've picked a site off the Monero, and as I said earlier, this was that eastern area didn't have it so good. So again, this is the previous 12 months, and this 12 months, as everywhere, very dry. Big East Coast low came in, huge drop, but it was almost a one-off. It occurred in 3 days, and there was very little moisture. Things really fell away again. Another East Coast low, another big drop. Things started looking better for them, but then they, pasture started growing and quickly sucked moisture out of the soil. And this rain just of late, you see, that's the rain that's really just occurred over the last couple of days, is starting to push things up. So producers here, they were very happy with this event. At this point, they were starting to get very nervous again. So this has been very welcome rain to give them a bit of confidence of where this season might keep going to. Now, this is that pasture page for this same site, and I mentioned, remember how the 3 lines at the last site stayed close together. Here's a site on the 1st of October where soil moisture was pretty low, and look at the potential forecasts from there. It was going all over the shop. i.e. it was saying this site really needed rainfall to come in to drive it. Well, it didn't come in, and you'll see the tracking line fall away, and towards the end of in October, they started getting some rainfall, and it's now starting to move in a more positive position. So that's all I'm going to show on that. these sites are there, and I think they'll become more used by more producers over time. I know this site, which is at present southern New South Wales, there is certainly discussions that of this expanding into the southwest slopes and the Riverina and potentially the central and northern tablelands, and I'd expect to see that occur sort of early in 2021. Just going back to a bit of a basic principle, what drives livestock performance? Well, there's two things. It's pasture that drives performance, and it's the combination of the quantity of the pasture and the quality of the pasture or digestibility. So I'll now use that word. It's those two things in combination which drives livestock performance. And the summer we're going into in the autumn, it is going to be the digestibility component of the pasture that will be the most important. We're going to have a lot of this in the system, but if that goes the wrong way, this doesn't get you out of a hole, and that's the thing we need to talk about. It's going to be, to some degree, the invisible part of the pasture, which is going to be the major driver for livestock performance, and that's the livestock performance of our own stock we got on the property, or it's the livestock performance of stock we might decide to trade. And again, I've just pulled a card out of the Progray's manual about digestibility. The key things with digestibility, you know, when things are actively green and growing and leaf, digestibility is high. We get a drop in digestibility, and as we get a drop in digestibility, we get a drop in energy. Those two things are very directly linked. Our pastures are most likely, it depends where we are, we're somewhere in this phase. So as the plants go into the reproductive phase, the digestibility drops. The digestibility drops because the plant is changing its internal structure. We're getting less leaf and more structural material in there. That what makes this structural material, the stems, etc., is material that the rumen bugs can't break down. So the amount of the material the animals eat, which they can utilize, which is really what digestibility is drops. So that's it in sort of theory, but let's put it into really what's occurred on the last 2 years. And again, I most likely want you to focus on this, again, another very elegantly drawn line down the bottom. In 2019, we were going through spring, and then suddenly we lost soil moisture. So the plant was under moisture stress, and that basically curtails the plant going into the reproductive phase. They've partly gone into it, but they can't go all the way through. So the net impact of that is the digestibility of our dry material ends up being higher than what we might normally regard as a normal year, right? Because the moisture is chopped off the reproductive process. Now, I know right now a number of producers are going out and spraying paddocks with Roundup. They're doing the same thing. They're using Roundup to if you like, freeze the paddock at a higher level of digestibility. We come to 2020, and you saw from the moisture profile we got in the soil, moisture is not going to be limiting plants this year. So they will be able to go through this reproductive phase. It's a long and complete reproductive phase. And the impact of doing that is that the digestibility ends up dropping off further. So if you think about, you know, I sort of drew 2019 up here, I'd expect 2020 to be down here, right? So a big difference in the digestibility of our pastures, mainly driven by the length of the growing season. And I'll make some comments on stubbles in a minute. So nature tends to help us. If spring's tough, the helping hand is the digestibility of that food we've got is higher. And when we go the other way and we have big herbage masses, the digestibility of our food will be lower than we'll expect, but the pastures won't look any different. It doesn't hit you in the face. So over the years, I've measured up to a difference of up to 10% in digestibility of our dry summer feed between dry years and good years. And to some degree, we've gone back to back. You know, between 19 and 20, I'd expect the differences to be 10%. As I said, it's not visual. So what's that mean to livestock production, well, if we just use a dry sheep, and the same principle applies in cattle. In 2019, while there was pasture there, on the dry feed, the sheep could maintain weight. The same animal this year will have plenty of feed in front of it because of that lower digestibility of 10%. They could in fact be losing half a kilo a week. Now, animals losing weight over summer is nothing new. That's not a problem. The critical thing with weight loss is how long does it go on for, and how much weight loss can we tolerate in our animals? So we'll get onto that later. So if we go now over for the mixed farmers over to stubbles, the same principle applies, and some of the data I've got in here is from measured data I took off the southwest slopes during the 2000s. A big harvest year, which everything's looking positive for. The stubbles across all crops, and this was both cereals and pulses. We measured the digestibility of the resulting stubble in that year was down at 30 to 35%. It really didn't matter. So we had lupin stubbles, which we're measuring with a digestibility of 33%, just as the benchmark cardboard's 30%. So we've got a lot of stubble at a very, very low digestibility where stock have real troubles consuming much of it. Whereas if we compare that with a year when, through unfortunate circumstances where it was a poor harvest year, we were measuring stubbles in the range of 45 to 53%. And that variation in where the stubbles were really did bounce around between paddocks, just how well that paddock yielded. So if it was because of better aspect or a different variety or timings or things like that, if the crop yielded a bit better in that dry year, we straight away saw the drop off in digestibility. And if the crop was a real dud, the digestibility went up. So what's that mean for those stubbles which you're going to have out there, and a lot of them? So if we just take a digestibility at 33%, a dry sheep can only eat 0.4 of a kilo, and that's just because the digestibility is so slow that there's very little in it for the bugs. The bugs are breaking down the material they grow. And if there's not much in the stubbles, their ability to break the material down, if the material isn't broken down, the animals can't go out and eat. So it has a real digestibility is a major driver of animal intake. And as you can see, 0.4 of a kilo is all they can consume, and they'd be losing 2 kilos a week. Whereas if we get a stubble at 48%, intake goes up by nearly threefold, 1.1 kilos, and they're only losing 0.4. So you can see, just like on digestibility had an impact on animal production on pasture, it's also having an impact on stubbles. And the other issue in managing those stubbles is they're going to be very big stubbles, and they're going to be hard to stock aren't going to chew your way through the big stubbles. So there'll be some issues there I think you'll need to think about in managing stubbles. So where's the impact? And I suppose the biggest impact I've seen over a number of these big years is the joining percentage in sheep, especially the sheep that are joined sort of most likely late February onwards, are always below average. It's the classic. The bigger the spring, the lower the joining percentages come the following autumn. And of course, that then flows through to your sheep numbers in the following year. The joinings that are occurring in summer aren't affected, and most cattle aren't affected because a lot of them are being joined in late spring. Cows that are going to be joined in autumn, the same effect can occur as the top line with sheep. The great advantage between cattle compared to sheep is you can very easily see what's happening to condition, whereas wool is a great cover of all sins. And why do we get the problem up the top? The longer the years grows, the lower quality feed, the more weight they've lost. The paddocks have plenty of feed. The sheep look okay. And let's be honest, after some tough seasons, you get a good year, the natural reaction is you tend to relax that's what's happened in previous ones. But that relaxation has ended up having an impact on the bottom line. It's an easy problem to solve, and you can solve it by management. The critical thing is that you're aware that the pastures or the stubbles this year are going to create some issues and need to be aware of, and with management you can get around them, but if you're not aware of it, you could be very disappointed. Right, now let's move on to fodder conservation. A fair bit of that's being talked about at present. It's my view that making poor quality fodder is an expensive operation and doesn't do anything positive for the business. And I might even drop to my very bottom point while I'm on about that. And again, it's my view from experience that 10 to 20% of wrap silage is wasted every year. So, you know, if you're wrapping stuff up, material up, it's not being used. Well, it can't be used because the wrap's been damaged, and therefore the internal consequences, the contents are rubbish. That just increases the cost. I've never found it a great idea to go out and make fodder because I've got a lot of it. I think you need to be a bit more tuned into why you're doing it and what you're cutting. If you want to cut quality product this year, I think you need to be reacting now, and for some areas that might even be past a little bit. You know, I said earlier on that the season's most likely 3 to 4 weeks ahead. So if you're normally thinking of making fodder in November, your pastures could be at that stage now. Be very clear about what you want the fodder before. Are you making this fodder because you want animal performance out of it? You want to be able to feed it to animals to put on weight, and those animals again could be trade animals or your own animals, or is it for maintenance? I don't really see the point in just going out and cutting fodder for the sake of it with no idea about what you're trying to do it. So if your goal for cutting this product is to drive performance, well, you have to cut quality. So you can go and get feed tests. There are a number of feed labs around in both New South Wales and Victoria which can provide a rapid test on your pasture sample. You know, if your quality's already past the point that's going to give you good animal performance, well, do you persist in cutting with the fodder, right? So just be clear about why you're doing it. Fodder conservation costs money. Yes, you've got surplus feed, but there's money cost to turn it into something. So you want to make sure it's a successful process. No matter what fodder system you use, so whether it's hay or silage, the quality of your fodder will always be lower than your pasture. So if your pasture's already are dropping into the 50%, that means the quality of your fodder, even if you do it well, is going to be towards the low 50s. And with the forecast we've had from the Bureau, it's not looking a brilliant, it's going to be a risky year for fodder due to the amount of rainfall. So again, if your quality of your pasture is already starting to get to the doubtful area and you're cutting it and it gets wet a few times, you very easily end up with a product of low quality. So yes, it's a great opportunity. A lot of people will be down on reserves, and having some fodder reserves makes a lot of sense. But just do it in a thoughtful manner. Don't sort of get lulled into the fact, oh, I've got a lot of food, therefore I've got a lot of silage. And just store it in the time frame that suits your intended uses. And what I mean by that is specifically with wrap silage. You know, I'll see people who'll wrap silage and they were always intending for that to be used in 4 or 5 years' time. It's a product for 12 to 18 months use. So make sure what you make lines up with what you want to do and when you think you might use it. Another one which has got nothing to do with pastures, but it's got a lot to do with livestock. This spring, this year so far has been very good for pasture growth, and I can tell you anything that's good for pasture growth is also good for worm populations. They're not being put under pressure, and they will be building up. A new threat we've had, and there's no doubt about that, barber's pole is becoming a bigger problem in southern New South Wales and Victoria, certainly over the last 5 years. When I started back in '88 on the southern tablelands, we hardly talked about barber's pole, and I reckon that was the case for 15 years. I would have spoken more about barber's pole in the last 5 years, and it's spreading south and it's spreading west. I've seen barber's pole outbreaks, west of Wagga, where you think, nah, the environment, it just wouldn't show up. And particularly right now is the window. If barber's pole gets away on your country now, it's going to have a big impact on young stock, sheep and cattle, come sort of December, January. So you really need to be, if barber's pole has been an issue on your place before, and it's not on all properties, now's the time you really need to be monitoring larval differentiation to see, have I got barber's pole present in those worms? And if you have, you really need to do something to try and flatten the population now, because if it gets away on you now, you're going to have a lot of problems later on. And in 2016, I can remember very clearly, the start of spring wasn't as good, but it finished very strongly and people were really happy with the way things going. And then in January, barber's pole came in and there was some enormous losses of young stock due to that. So worms will go with seasons. So we're having a good season growth-wise. It's going to be an issue with worms. But again, what's your tool to manage that? It's monitoring. If you do that, you can get on top of them. Another thing I think we just need to talk about is pasture decay. And again, decay is not necessarily that visible. The paddock doesn't change much, but material can be disappearing out of it. So we know clover breaks down. This has been a massive clover year, as I said, and in a normal year, once clover hays off, that clover residue can be gone in 3 weeks. If there's moisture in the system, that clover residue could disappear very quickly. So I've been looking at some paddocks recently where the paddocks are predominantly clover. In another month's time, those paddocks could look quite different because that component of the pasture is going to disappear. The clovers will hay off regardless of moisture. They're an annual, they're driven by day length factors, etc. So they will end up, we're going to have moisture in the soil, but the clover is going to disappear. So just be aware that the characteristics of your pastures could change quite considerably over the next month. And it's the high digestible parts of the plant that go first. So once things, and again, if decay is partly driven by a breakdown, if parts of the plant get on the ground, the same bugs that are in the room and are breaking that are in the soil, and they're breaking material down, and the high digestible parts are the parts they like. Now, with increased moisture, and especially if pastures get wet and stay wet for 3 or 4 days, the rate of breakdown can be substantial. Now, down the bottom, I've measured a loss of 1 tonne in a dry December. So there was nothing in this paddock. And if you looked at the photos, it looked no different at the start of the month to the end of the month. But 1 tonne or 25% of the food disappeared in that month. If we had moisture in that system, the amount of material we could lose could be up. Purpose of talking about decay, your pastures in 6 weeks' time might not be as big as they are now. You are still going to have feed. You're still going to have surplus feed, but the quantity mightn't be quite as big. And this is where it gets tricky this year, in that it depends a bit what moisture does. So a very wet November could see could speed up quite a bit of decay of our feed we've grown so far. Now, depending where you are and what your pasture types is, if December's then wet and we've got species that can respond to that December rain, we've lost some material, but it'll be replaced by fresh, green, high digestible material. So we've lost some, but we've gained. In the end, balance it all up, we're in a better situation. If we get a wet November and then December's dry, we've lost some of that November feed, and we haven't had the feed coming away. So is decay going to hurt us or not? It depends a bit on what on how the rainfall, what the rainfall patterns are. But I just want you to think about, just don't assume what you're seeing out there now is what you're going to have in 2 months. Trading, which livestock? Yeah, from my view, it's the prices, and it's the sort of information that you heard from MLA. It's the availability of stock, and it's just your facilities on your property should determine which class of livestock you want to trade in. If we're trading, we want to put weight on stock. So you need to be sure that your pasture quality is adequate to achieve the weight gains you need. My point about facilities is, over the years, I've seen people who, it might be a cattle property and they decided to trade sheep, or it was a sheep property and they tried to trade cattle, and it wasn't that successful because of a facility. So on the cattle property, the fences were not suitable for taking on trade lambs, and they suffered because when they ended up selling them, they didn't sell the number of animals they bought, principally because they'd gone walkabout and they never got them back. Sheep producers, no cattle facilities, no yards, have to drop them off in a neighbour's place, walk them up the road, haven't got the ability to check on what weight gain's going on. You know, those things can take the edge off a profitable trade. And all of you out there, if you do want to trade, you're trying to make money. And, you know, at present, I think the prices, etc., are tight in the trade. So you don't want to have something like facilities just taking the edge off it. So I've talked a fair bit about pasture quality, but you know, it's a case of being aware of that, and factoring that into your thinking. If I'm taking these class of animals on for 3 months, you know, what's the profile of my food? It's just not what food have you on the place now, but what's my profile of quality food going to be like in December and January? If we're in the mixed farming zone and lucerne and the moisture's there, you haven't got any worry. You've got a fantastic finishing food. Go for it. If you're in a purely pasture situation, you just need to put a bit more thought into it. And if you're only going to achieve low weight gains, you in fact increase the risk of your trade. If you're getting really good weight gains, that means you've put the weight on in a short period of time. If there's movement in markets, you're in a position because you got the weight that can you potentially get out of them earlier. If you haven't got the weight gains, you're locked in, and then if the markets start moving, there's not much you can do about it. So being clear in your head that yes, I can trade and I have got the food to put the sort of weight on that I need is important. And just on the other side, I certainly know some people will regard cutting this year's fodder purely as a trading opportunity in dry time. So they'll cut the fodder, really with no intention of using it themselves, but they'll sell it in years down the track to try and buy a higher energy product in dry times. Rightio, we're getting down. What can we take? The potentially lower pasture quality is going to have its biggest impact on stock where we're trying to get production from, either weight gain or it's the reproductive status of our females. So on properties, we might well have other classes of stock who don't fall into that category, and they might do perfectly well on our feed supply. So my discussion about quality, which you think I might have laboured, but I've seen it hit people hard. It's really about those classes of stock where we want performance out of them. I've seen cows of late that are carrying so much fat that running them on low quality feed for 2 months is going to do nothing but a positive to them. So, you know, there's a class of animal and say, well, we can put them out in that country and everything will be fine. I've also seen crossbred ewes who would benefit by losing weight. The other thing on your property is not all paddocks are going to be the same in quality. So it's a case of, you know, I often regard running a property, it's a jigsaw puzzle. You just got to make sure that you're using the right paddocks for the right classes of stock. And we don't need every paddock to have high quality feed. As I just said before, we've got classes of stock who we can run on feed that isn't quite as good. And right now it's decision time about which paddocks you're going to put some grazing pressure on. So if we can graze country now, because there's moisture in the soil, we will tend to make the plant stay in a vegetative phase for longer. And in doing that, we're tending to counteract a bit that drop in digestibility I talk for. When those paddocks do hay off, they're going to be of a higher quality. So it's certainly a year where you've got to make some decisions. I'm going to look after paddocks, you know, A, B, C, and G, and let the other ones go. You just can't, with the sort of growth rates we're achieving, no one can maintain a place. And in doing that, this thinking about which paddocks am I going to try and keep in a higher quality for longer, you know, take account of your pasture species, take account of aspect. You know, which country has the species that it will respond to summer rain. These years are often ones where a native pasture, which, you know, you mightn't think much of, can be of high value because they will respond to that summer rain and give you quality food. And if the quality feed's there, use it. And the class of stock who are after it most are those performance stock, and certainly our younger stock. So we give them a good start and set them up to be long-term productive animals across our property. So there's some decisions there that needs to be applied right now, that of which of the paddocks am I going to concentrate on, and which of the paddocks I'm going to pull back and just let go. And you'll end up using them at some stage down the track. As I said, sheep are the ones, because of the joining time, who tend to have been hit harder by big seasons. And that, again, you just monitor the years when that's got away from people. It's because people relaxed and didn't realise that weight loss was occurring. If you know it's occurring, you can do something about it. So don't let a big years, just don't assume the stock are going to do well. Do your monitoring. And then if something needs to be done, you can do it. We're most likely potentially we're going to run into a summer where protein will be a bit more important for young stock, because as our digestibility drops, not only energy drops, but protein drops. So it could be a year where a bit more emphasis on protein, and that applies to both your own stock and any trades you bring in. Just remember that for the last 3 years, cereal grains have almost been the perfect supplement in their energy's been good and their protein's been well above average. Now for the croppers, they're very happy to see that those conditions aren't continued, because that was just the dry conditions. This year we're going to have high yields, and protein levels could be all over the shop, just reflective of what the end content was under that pasture. So if you are buying cereals, know what you're buying. And in the mixed farming zone, the last couple of years, cereal finishing of young stock, especially lambs, has been very successful. But again, that was partly driven by the fact that the grain had this unique combination of high protein and energy. That protein might be there, and if you're thinking of going down that path again, you just might need to be adding a bit more protein than you have in previous years. Last year's strategy worked very well. using exactly the same strategy this year, just might need some tweaking. So my conclusion, in all years, we need to manage what the season throws at us. Now, for all of you, you've been doing a lot of managing because the season's throwing 3 hard years at you. If you sit back and relax, and to some degree you're entitled to have done that over the next 3 or 4 months and think everything's just going to drop into place because it's a great year and we've got feed everywhere, you will be disappointed. A number of the issues I've raised, management will get round them. It's just being aware that it doesn't automatically happen. If you're on the ball and you check that and you think it through, you can turn what's a very good year into extra dollars. And thank you very much.
Thank you very much indeed, Phil. So we've now got Hilary Beech from Holmes Sackett, which is now Aggregate Consulting, as we understand. Hilary grew up on a mixed sheep and cropping farm in WA, and she moved to Wagga in New South Wales to complete a Bachelor of Ag Business Management. Hilary was employed by Holmes Sackett through the MLA Livestock Consulting Internship Program. And now as a senior consultant at Holmes Sackett, or Aggregate Consulting, Hilary's time is split between farm business consultancy, business skill development in farmers and industry projects and extension. Hilary enjoys working at a strategic and tactical level with producers, providing farm performance reviews, farm business plans, and analysis of management systems. And I believe the key messages from Hilary today will be that there are still opportunities to trade if you believe prices will remain supported. There is opportunity cost making fodder over trading livestock, and you won't be able to eat all of your fodder storage. You won't be able to eat it all. So fodder storage is the next option. So without further ado, Hilary, I will pass over to you. Welcome.
Thank you. Great. Thanks for the introduction there, Lucas. That was, I wish I'd done that down a little bit now. All right, let's get started. I obviously am going to talk to you today about surplus fodder opportunities. And as already stated, my name's Hilary. I work for Aggregate Consulting in Wagga, New South Wales. And thanks very much, AuctionsPlus, for having me on today to talk. It's a great opportunity, so I hope you'll get something out of it. So as already stated, I'm going to be looking at potential returns for livestock trading enterprises, so assessing if there are any trade opportunities in sheep and cattle, and what the margins might be. And then we'll look into potential returns where fodder is conserved and retained. So looking at the cost benefit of making fodder and then assessing the cost of storing that fodder, whether it be over a short or a long period of time. And we'll have a look at the assumptions around that. So making the most of a good season, I'm sure a lot of you are a bit bamboozled at the moment, possibly coming out of quite a long, severe drought. And then having this season that we're in now, which should be exciting, but I assume it's also a bit overwhelming too, looking at with all that grass that you've got. So I understand a few producers might have their confidence knocked around a bit over the last couple of years. So it's really important to assess opportunities that might present to you, but really delve into the analysis of them and making sure that you're making the right decisions at the time. And it's always good to get someone in to help you with that. So I'm sure you've all heard of this. A majority of profits are made in the minority of the years. So those are the years when there's good seasons and good prices align. So we really want to make the most of seasons like we're seeing right now. And because, you know, they are a bit few and far between at the moment. And again, we really need to consider the opportunities that are presented or that we go and look for really carefully. So we've got information about markets, but, you know, in the scheme of things, it is a little bit limited. And then we've also got extremely limited information about seasonal conditions as well. So you really need to put some risk mitigations in when you're making these decisions, and consider them really carefully. So essentially there are 3 things you can do with surplus grass this year. You can trade stock with it, you can store it, or you can do nothing. And there is risk involved with all 3 of them. The third option, so doing nothing, is probably what I would try to limit or avoid as best you can. So you want to be able to do something with that surplus fodder, because the opportunity cost becomes quite great when you just leave it in the paddock and not do anything with it. So the first 2 options are really what you want to try and capitalise on in this season. So trading stock or storing it, and then we want to sort of limit the amount of wastage that comes out of this season, although that's going to be quite hard. Okay, we'll just delve into some trading opportunities now. So as Phil sort of alluded to, trading, the market's pretty hot right now, and medium-term trades are really marginal. And the ability to pull the trigger or capitalise on a trade is dependent on where you think the market will be when you sell, and that's sort of where you take into account what we've heard from the MLA markets team, where your sort of experience lies in the trading sort of realm, and where you really think what your sort of appetite to risk is as well, and where you think the market will be when it's time for you to offload that trade. So when you're looking at that, you want to assess what's supporting these prices. So you're looking at a good season at the moment. There's tight supply from global exporters. So Australia is a key global exporter. And then also the African swine fever, which has ripped through China. And there's about a 25 million tonne void in meat production. I think something like 17 million tonne can't be filled. So there's good factors which are supporting the prices at the moment. But then we also have the short to medium term market concerns, which are quite apparent at the moment, looking at COVID-19 disruptions in processes, global demand and export impacts. We also have a high Australian dollar at the moment. And in this short sort of few months ahead, we've got that spring flush that'll come through and flood the market, I guess. So you're looking at some concerns there. But long term, as the guys from MLA alluded to, it looks good as long as we can, maintain that COVID-19, not let it sort of disrupt the processes too much over this period. So accommodating for risk. So how much risk is there? Well, that's the question at the moment, I guess. It's sort of one that we can talk for days about, and it's one that also you need to take into account your own appetite for risk and how risk averse you are. In the trades that I'm about to show you, I use a 20% return on investment buffer. So the gross margin of the trade needs to be at least 20% return, and that just accounts or covers for the risk that you're likely or that you're exposed to when going through a trade. So that 20% return on investment is what I've used to buffer the risk that you're exposed to when you're trading. So medium-term trades, are there any? So we trawled through AuctionsPlus, and we found a few that looked like sort of just on that 20% return on investment figure. So I'm going to run through a few that's growing out steers, purchasing in heifers to join and sell, purchasing wethers in for wool and weight gain, and then purchasing ewes in to join and then sell. And I've used merino ewes as an example to look at. So what I've actually decided to do is work backwards. So when I said before, the ability for you to pull the trigger on a trade is really reliant on where you think the market will be when you go to sell that trade. So we'll to work out what you can then purchase, what the purchase price can be, given the assumption on what the sale price will be. We'll work backwards to work that out. So just looking at this steer trade that's on the screen now, up the top is that return on investment figure of 20%. I've assumed that a sale price, so you're buying in sort of yearling steers now at around 290, 300 kilos. A sale price at the end of the trade will be around $4 a kilo, and I've assumed they're going to a feeder market, so around that 440 kilos per head. So the sale price will be around $17.60. I've assumed some selling costs of around $100 a head, and that takes into account commission. It has some death rates in there as well, levies and yard fees, those kinds of things. So they might be on a bit of the higher end to what you're expecting, but at least I've allowed for that in this calculation, and then we can work backwards from there. The net farm value of $16.60 per head. I've assumed some animal health costs of $30, which again are on the higher side. A lot of you probably won't be looking at animal health costs, so that's your induction and other drench costs and other animal health costs you might incur. So again, that's probably on the higher end. Purchase costs of $30 as well. So that includes your freight and any other purchase costs that you might incur to get the animal on the farm. So the net gross from that, so your net on farm value minus your animal health costs minus your purchase costs is $1,600. The difference between the purchase price, so the net gross and the purchase price, needs to be that 20% return on investment to give you the gross margin there, so to cover for that risk. So your purchase price on this trade is $1,333 per head, to give you a gross margin of $267, which will be 20% return on investment on that trade. Oops, actually I forgot to. So that should say trade gross margin is 20% by your purchase price, sorry, not your net on farm value. I will change that. And then your margin from weight gain on there. So I did update these slides quickly before I got on, and I forgot to change a bit of that wording. So just ignore what's on the right here. Again, if you want a 20% return on investment of a sales steer at $17.60, your purchase price needs to be $13.33 there to get that gross margin of $267. All right, so as Phil alluded to, a lot of your trades that you'll be looking at, or a majority of them, will require weight gain. So your trade average growth rate from the benchmarking, the trade average growth rate that we see is 0.7 of a kilogram per head per day. So if you buy in a 300 kilo steer and it grows at 0.7 of a kilo per head per day, that's a 200-day trade. And as Phil alluded to, the pasture digestibility is going to start coming off if it hasn't already where you are. So you've really got to be sure that you can make that weight gain. And if you can't, so if you're, you'll be trading this steer over that sort of January, February period, if you can't make that weight gain, what does that mean in terms of your sale price you've assumed? Does it push it out or back. So just be aware that, you know, that weight gain is really, really important to this trade. So you've got to make sure that your assumptions are in line with what you think you can practically do. So over on the left, if you're looking at your purchase weight for this steer that we just ran through, steer trade that we just ran through, your purchase weight, say if you wanted to buy a steer in at 300 kilos, your purchase price will be $4.44 a kilo. If you find some that are 350 that you want to grow out, again, making sure that you can make that weight gain, you can purchase them in at $3.80, but again, your feed conversion starts to slow down there. If you go up the other end and you can find some yearling steers or maybe some wares for 250 kilos, you can purchase them for $5.33 a kilo of live weight to make that trade and worthwhile to get that 20% return on investment. Okay, just a few more to run through. So working backwards, we're looking at heifers to join and sell PTIC. So again, that 20% return on investment there. I'm assuming that buying the heifer and joining her to sell her PTIC in sort of April, May next year, depending when how early you can join her, the sale price will be about $1,800 a head. Again, selling costs of $100 a head. I've assumed a joining rate of 85%, and those heifers that don't join, their value tested empty is $1,400 a head. The net farm value is then your $1,640. So I've taken into account that 85% of that trade will sell for $1,800 a head. And then the 15% of that trade will sell for $1,400 a head, which gives us a $1,640 per head on farm value. Again, $40 health costs and purchase costs, again on the higher end, gives you a net gross of $1,570 that you have to play with. To get that 20% trade gross margin, you need to purchase that heifer at $1,308 per head, which gives you a trade gross margin of $262, which is 20% of your purchase price. So if you look over on your right, again, say if you're thinking, okay, Hilary, you're being a bit, you're pulling back on the market, I think they'll be worth $2,200 pregnancy tested in calf at the time of sale, then you can buy that heifer now for $1,592 a head, so $1,592 a head. If you think the market's really going to fall away and you think she's only going to be worth $1,400 at that time, then the purchase price will be $1,025 per head. So again, it's where you think the market will be at the time of sale. Okay, looking at some weathers now, assuming I can run through these a bit quicker now, I think. Assuming the sale price of $100 a head, I've added a fleece value in there of $40, minus your selling costs is $132 net farm value. Minus all your shearing, animal health costs and purchase costs, you have a net gross of $116. To get that difference of for your 20% return on investment, your purchase price there is now $96 per head, which will give you a gross margin of $19 and a return on investment of 20%. So buying a wether in at $96 now, getting a fleece off them for $40 a head and selling them for $100, you're making a 20% return on investment. Again, over on the left here, say you think you're not going to get that type of fleece value off them. If you think the wool market's got a little bit more way to go, and still maintaining that sale price of $100, then you can buy that wether now for $88 to get that return on investment of 20%. Okay, and then the last one, looking at merino used to join and sell scanning lamb. Say you think you can sell her scanning lamb for $275 a head. Again, a fleece value of $40, that might be a bit bullish. You might need to pull that back a bit, depending on if you buy her off shears or unshorn, depending on what you can obtain. And again, the selling costs, I've assumed a joining percentage of 100% and a dry value of 230. So your net farm value is $305, which is essentially your sale price plus your fleece value minus your selling costs there. Minus all your shearing costs, animal health and purchase costs, so your net gross is $286. To get that 20% buffer, you can purchase that ewe now for $238 a head, which will give you that $48 gross margin per head and a 20% return on investment on your purchase price. So over on the right, if you're thinking it's unlikely that you'll be able to get that type of joining rate out of the trade, and you're thinking around 85%, but a similar sale price of $280, then you can purchase that ewe for $231 now, that trade. So hopefully that gives you a bit of an idea of the types of trades and margins that you're looking at the moment. And if you can sort of take these figures with you, jump on AuctionsPlus and trawl through the, or get on and on one of the sale days, and then you have your base price, which you can purchase at, or your maximum price that you can purchase at to get that return on investment on those trades. So, and if you need some help sort of running through these again, I'm available after this talk to sort of put some of your assumptions in, if you like. All of those, they should be pretty easy to follow with the lettering on the left. Should give you a bit of an idea of how I got the figures. Okay, again, assumptions. So your animal health costs, I've been quite bullish with them. They can probably come back a fair bit. But again, it shows that, you know, I've been quite conservative with the, you know, your purchase prices, I guess. So it's likely that you can bump them up a little bit depending on what your assumptions are. Your selling costs include deaths. I did state that. Joining percentages, again, will impact on the trade and what you can purchase that trade at. Your weight gain, again, making sure that you are able to target that weight gain and that it's realistic, and that you know, you're getting on top of the pasture now before it starts to turn into highly like not very digestible, as what Phil was saying, and that you do get good conversions rates out of it. And then the last one is your commission. So your transaction costs have a real significant impact on your trade outcomes. So again, using AuctionsPlus is a really good tool to be really cost effective with the trades and avoid any sort of unnecessary commission in there. Okay, excellent. We'll jump on to some fodder conservation now, and then we'll kind of combine the two and look at what are the best options for you. So we'll look at what are the direct cash costs to making fodder, assuming surplus pasture growth, looking at what the hidden costs are, so nutrient removal from taking fodder from harvesting fodder, what the opportunity costs are, and then what the costs of storing fodder are, which is probably the most important aspect of fodder conservation at the moment. All right, so the fodder conservation assumptions I've used have come from the DPI, and I'm not an expert in harvesting and cutting and all the things that go into fodder conservation. So I'm sure Phil would be able to help you out on what best tactic could be used on your property. I've looked at silage and baling silage, putting silage into a pit, and then hay making. The assumptions that I carry on with, I've used hay baling as a major fodder conservation that I'll look at when assessing the opportunity costs. And that's just because I've assumed that the audience today would be inexperienced with fodder conservation and would be looking for the most practical, easy, and what I've looked at, the most cost-effective way of conserving fodder. When you move into making silage, there's a bit more about it's a bit more intense with timeliness and making sure your contractors are right onto it, because you can lose a lot of quality really quickly if you don't get it right. So I've assumed also that we're looking at mixed pasture, so temperate pasture systems, and that what you might be looking at still, if you're in southern half of, or southern quarter maybe, or third of Australia, you could still possibly get in some silage, but most of you will be looking at now possibly cutting hay instead. So this is the contracting cost for making hay at the moment. So assuming your pasture quality has declined and your yield increases, then hay is a more suitable option. Again, these cost assumptions come straight from some friends at the DPI and dairy who've worked a lot in dairy, so are the fodder buffs, I guess. So essentially what I want you to focus on this slide is this conservation cost dollar per tonne in dry matter, and that's around $82 per tonne of dry matter for your contractor costs to make that, to make hay, I guess. What I haven't looked at essentially is any work that you do yourself with your own machinery. I've just purely looked at the cost of getting a contractor in, because I've assumed that most of you don't do it on an annual basis. But it is really economies of scale. So the more you do, the more frequently it's probably not a benefit, but the more you might look into having your own machinery to conserve fodder on your own time. But again, if you're only doing it, it's a year, it's a one-off year, you're just looking at it for this year, then you're definitely going to be getting in contractors, and you're not going to be going out and buying your own machinery for this process. There is a lot of information on the cost of owning fodder machinery as opposed to getting contractors in, and in terms of the types of different machines and tools and implements that you need to do the job. There's a top fodder manual from the DPI and AgVic. There's plenty of information. There's been 2 webinars come out, one by MLA recently, and then another one by AgVic. So if you need more information on this sort of stuff, it's readily available. So yeah, hay bale cost, you're looking at around $82 per tonne of dry matter. Silage baled cost, because you've got that wrapping in there, it really blows the cost out. So we won't be looking at baling silage today, which is around $200 a tonne of dry matter. And then putting a silage into a pit is around that $98 per tonne of dry matter. But what you've got to also take into account, I guess, is that getting the silage out of the pit needs special equipment unless it's self-feeding. And then there's other implications in making a self-feeding pit too. So we'll just be purely looking at baling hay today. All right, so the cost of long-term fodder storage. So over on the left here, you can see what is it worth in the future. So today's cost of fodder, that cost to contract to bale that hay, you're looking at $82 per tonne of dry matter. Number of years stored, I'd assume that, so the point of storage, I guess, in what I've looked at is that you're storing it for drought, for future drought events. And as Phil alluded to, quality is really important. If you're looking at using the fodder for production, what I'm looking at is using it for maintenance during a drought. So I haven't taken any of that into account today. I'm purely looking at it from a tonnes per dry matter point of view. So $82, the cost of making that fodder, stored for 5 years, a discount rate of 10% because there's still some risk involved with fodder storage above and beyond wastage. And then you're looking at a wastage of around 5%, which, you know, depending on how you store it, you know, can be quite a lot higher, I guess. So there is a fair bit of risk involved. So the future cost, so if you pull it out, you make it today for $82 a tonne, you store it for 5 years. If you pull it out on the fifth year, the cost of that fodder as fed is $126 per tonne of dry matter as fed. So how much can you pay now? So say on that year 5, you assume that you'll be paying, and it's a drought year, you assume you'll be paying $300 per tonne of dry matter to feed out. Again, it's been stored for 5 years, discount rate of 10% and wastage of 5%. So today's value is $195 is what you can purchase the tonne of dry matter for now to make that storage worthwhile. So the margin from storing fodder now is $113 per tonne of dry matter, which is your as fed value in a drought year minus the cost of making it now. So again, the higher the future value of the fodder, the higher this number, so the greater the margin from storing fodder. But if you pull it out in 2 years and it's only worth $250 a tonne, I'll show you what that looks like. For example, so if you pull it out in 3 years and it's only worth $250 a tonne, then it's worth actually a bit more because it's been discounted over a less number of years. But if you pull it out in 7 years, so it's been stored for a long time, there's a large opportunity cost involved with that, that product, and you pull it out in 7 years for only $250 a tonne, then you're looking at $52 as fed there, or the margin between, the margin from making that fodder and storing it is $52. So the longer it's left in and the lower the value when you pull it out, the lower the margin of storing that fodder is going to be. Okay, some hidden costs for you. So nutrient removal. When produce is removed from the farm, it takes key nutrients with it, and these will need to be replaced. So just got some examples up here for you, which are your main sort of key nutrients, N, K, P and S, or N, P, K and S. So these are the kilos of nutrient removed when you take a product from the farm. So a kilo of meat is worth 0.03 of a kilo of nitrogen removed. A kilo of wool is worth 0.12 kilo of nitrogen removed, and a ton of dry matter is worth 25 kilos of nitrogen removed. And again, so forth down the line. So these might seem significant, I guess, but it's there, and it should be sort of accounted for, and maybe something that you don't recognise, even I guess in a normal year when you're removing, when you're sending a truck of lambs off at this time of the year, how much nutrients they're actually taking with them. And then some opportunity costs. So the cost of losing an opportunity when an alternative is chosen. So what we're going to be looking at today is the opportunity cost of making fodder as opposed to trading stock. So in the case of fodder conservation, the main opportunity cost is foregone grazing. And that's what we'll be sort of tying the two, fodder conservation and trading opportunities together. So in a normal year, say if you get to July and whenever, and you lock a paddock up for the purpose of making hay or silage or whatever you normally do, then there's an opportunity cost in doing that. So for example, in a year where the market might not be so hot, you're looking at a gross margin for a trading enterprise of around $350 a head. Over the 30 hectare paddock that you might be making fodder, you can run 75 trade animals for a gross margin of $26,250. If you were to make that same, turn that same paddock, and instead of trading, you're going to cut it for, we used hay as an example. So that 30 hectares, your break-even storage value is your $82 plus your margin from storing it over that 5-year period, which is $195, minus your cost, minus your marginal nutrient removal. So that is the difference between the nutrients removed from the steer trade and the nutrients removed from the fodder making. So there's still $200 per hectare removed from on top of the trade from your fodder making. At 5 tonnes per hectare, your gross margin is $10,913. So the opportunity cost of making fodder is $15,337 or $511 per hectare. And if that doesn't turn you off making fodder for the rest of your life, I don't know what will. Just also in regards with this nutrient removal, you may have some paddocks where you don't need to replace that, those key nutrients, but there's a fair bit in there, and you'll probably only be able to do it once before you do then have to replace that nutrients annually. So it might seem like a lot if you don't do it, but that's probably because you have nutrients you can mine, but you'll only be able to mine them for a certain number of years before you then have to replace them. So be aware of that. So again, there's significant opportunity cost in making fodder over the top of looking at trading stock in a general year. Again, the storage value, which is your break-even storage value, a higher storage value and lower production costs reduces the opportunity cost. But again, the value of you storing that fodder has to be fairly high, and your production cost has to be fairly low to make that. So what you're looking at here is your opportunity cost. So it has to be fairly on the upper end for that opportunity cost to still be low, and that's, you know, $250 a hectare opportunity cost is quite significant. So you'd have to make some pretty high value fodder for it to be worthwhile, I guess. So if you're looking at sort of a scenario now, you know, what to do now? Well, Hilary, this is not a normal year. We're looking at trades where you're getting half that sort of income or gross margin. What does it look like at the moment? So what I've just done is gone through and I've just halved the gross margin return dollar per head that you would get from that same steer trade. So from $350 to $175 per head gross margin, you're looking at $13,125. Again, the same figures over on the right here. So your fodder gross margin is $10,913. So if you halved your trading gross margin, you're still $74 per hectare better off trading than you are making fodder at this time. So daunting, but you know, it's in front of you there, so something to think about. I will sort of also point out, though, it's really unlikely that you will be able to utilise all the grass through livestock. So I did a fodder budget for this exercise for a producer in Tumbarumba in New South Wales, and they currently have 3,137 kilos of dry matter per hectare. We ran the budget out for 160 days, so assuming the break will be around that March time. So in 160 days time, the target dry matter we're looking at will be 2,000 kilos of dry matter per hectare. So that's what we want to have at the point of the break. With the pasture growth rates assumed and the number of stock that's on now, this producer will need an additional 1,500 steers to target that, to get that pasture down to a 2,000 kilo dry matter per hectare target. So on top of what they've already got, they'll need to trade an additional 1,500 steers to eat all the grass that they're going to grow over the next 160 days. So it's really significant. And that's why I'm saying it's unlikely that you'll be able to utilize all the grass through livestock. And so why not both, I guess, as the famous taco girl once said. Essentially, I'm saying that you won't be able to trade enough. The opportunity cost is there if you don't, but when you're looking through AuctionsPlus, and a lot of you will have more than 3,000 kilos of dry matter on your place at the moment, because that producer was certainly at the higher end of stocking rate. So, you know, you should at least be trying to trade and finding trades if you can. But as well, on top of that, looking at fodder conservation, looking at the cost of making fodder and storing it, and then utilising your pasture that way. So if you can't eat it, you should be looking at storing it for the time being, as opposed to, I suppose, letting it go to waste. All right, so just to finish off, there still are trading opportunities if you believe the market will remain supported. So have a look through AuctionsPlus, get your key base purchase price sorted, and be ready to capitalise when those opportunities present themselves. There is significant opportunity cost in making fodder over trading stock. Real significant opportunity cost in a normal year where the market's not so hot, I guess. But even in years like this, there is still opportunity cost in making fodder. But again, it's likely that you'll have to do both to utilise that, those pasture, all that surplus fodder that you have. Okay, thank you.
Thank you so much, Hilary. Great presentation. It looks like that is that. So thank you so much once again to Hilary and to Phil and to the MLA. Thank you so much everyone for tuning into AuctionsPlus Presents. We will be compiling our highlights of this recording of this webinar, and we will be distributing it. So keep an eye out for that. Have a fantastic day. Thank you.